Welcome to this week's episode of Accredited Investor Markets Radio. Each week, we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. Later on, we'll be speaking with Tracy Treger. Tracy Treger is with Syndicated Equities, and she will tell us how 1031 exchanges work. What's a 1031 exchange? Well, of course, Ms. Treger will provide more detail. But if you sell investment real property and purchase other investment real property, you could, through a 1031 exchange, defer all capital gains taxes from profits you made on the first sale until, well, kingdom come, maybe. Anyway, it's a significant issue for such investors, and such investors are tall and small, individuals as well as larger concerns. So let's talk about water. Let's talk about some of the wonders of water and within the water. Get back to a little bit more real estate, maybe some rocketry before we're done. And then we'll get to Ms. Treger. Right, the first article I want to discuss is kind of amazing, or at least it touches on something amazing that we're going to speak about later on this program in another edition. The article is from the Jerusalem Post, December 15th, and it's about an Israeli company, IDE Technologies, which is building a desalinization plant outside of San Diego. It will be called the Claude Bud Lewis Carlsbad Desalinization Plant, and will provide 10% of the water needs for San Diego County. And this will be high quality water you can drink, which is roughly 190 million liters of water daily. And what does this have to do with this radio program? Well, in a few weeks, we're going to have Seth Siegel on as a guest. Seth Siegel wrote a New York Times bestselling nonfiction book called Let There Be Water. It tells the tale of how Israel turned an arid land without very many people living in to an arid land with 8 million people living in it, and more millions expected in due course, which has sufficient water for its needs and then some. And it wasn't easy. It wasn't a divine miracle. However, the scope of it is miraculous. So we're looking forward to that conversation. But in the meantime, IDE Technologies is addressing similar problems in Southern California. That's the wonders of the water. Let's go into the water, or maybe into a little bit of the water. I wanted to note that the U.S. Food and Drug Administration provides lots of things you can find on the internet about products you're interested in. I'm interested in ginormous fish, like the Aqua Advantage salmon. Aqua Advantage is a brand name, I assume, but it's spelled AQU and then the word advantage, all one word. And it is huge. I don't know how many times it is bigger than a regular salmon, but at least 10 times bigger than an Atlantic salmon when they're pictured next to one another. Obviously, if you can grow ginormous salmon, you can sell a lot of salmon meat. But to do that, you need the FDA to sign off. And I am reading from the Aqua Advantage Salmon Fact Sheet of the FDA, and you can find it on their website, fda.gov. And it tells us that based upon a comprehensive analysis of the scientific evidence, the FDA has determined that the Aqua Advantage salmon meets statutory requirements for safety and effectiveness under the Federal Food, Drug, and Cosmetic Act. They are safe to eat. The introduced DNA is safe for the fish itself, and the salmon meet the sponsors claim about faster growth. Therefore, the FDA has approved the application. So, Aqua Advantage salmon has been genetically engineered to grow more rapidly, to say the least, than non-GE farm-raised Atlantic salmon counterparts. Now, there are giant nets in the Pacific outside of Tasmania where salmon are farmed. This won't happen with the Aqua Advantage salmon. The FDA has determined that food from the Aqua Advantage salmon is safe to eat, just as safe to eat, and that the nutritional profile of Aqua Advantage salmon is comparable to that of non-GE farm-raised Atlantic salmon. But about where are they going to keep these things? How are we going to keep giant salmon from eating up everything in the oceans? Well, the fact sheet does spend some time on containment. I thought I'd read a little bit from it. Aqua Advantage salmon are subject to stringent conditions to prevent the possibility of escape into the wild. They cannot be raised in ocean net pens like those salmon outside of Tasmania. Instead, they may be grown only at two specific land-based facilities, one in Canada, one in Panama. In Canada is where the breeding stock will be, and Panama is where all the fish that will be grown and then sold at market will be grown using eggs from the Canada facility. Each of the facilities will have multiple and redundant physical barriers to prevent eggs and fish from escaping, including metal screens on everything, metal screens on tank bottoms, standpipes, incubator trays to prevent the escape of eggs and fish during hatching or rearing. But what if some bird grabs a small salmon and drops it in the ocean accidentally, and it grows to a big salmon and mates and creates massive salmon that take over our political institutions? Well, that's not going to happen, according to this, because the facilities must have covers, nets, jump fences, screened overflow tanks, tank netting above to keep predators such as birds from entering the fish tanks at the outdoor facilities in Panama. Also, and importantly, the fish to be produced for food in Panama will be all female and all will be reproductively sterile. Well, we hope so. I mean, the Illinois River and the Mississippi River have been overrun by Asian carp, which have eaten everything in sight. And the great fear is that they'll take over the Great Lakes and ruin those too. So, but the FDA has said, put the netting on top. Redundant physical barriers will be okay. One other issue, which is labeling of them as genetically engineered, not necessary. According to the FDA, manufacturers who wish to voluntarily label their food products as containing or not containing genetically engineered Atlantic salmon may do so as long as such labeling is truthful and non-misleading. But they're not required to do it because, as we already said, the food products are not materially different from their conventional counterparts. Gigantic salmon. Coming to Whole Foods in due course, I'm sure. Well, let's get to real estate then a little bit. There's an article in AIMkts.com, the mothership for this show, entitled Real Estate Crowdfunding, Malls and Boutiques by Michael Episcope. And Michael Episcope is a co-founder and principal of Origin Capital Partners based in Chicago. I wanted to draw your attention to this article, which is on the website, dated 12/25/2015, because it's short and divides up the subworld of real estate crowdfunding in useful ways. It divides it up according to two different dilemmas. Now, the purpose of real estate crowdfunding, as the article notes, is to make it as easy to invest in big commercial buildings as it is to invest in stocks and bonds, so the accredited investor take advantage of the big building opportunities, just like the big boys and big gals and the institutional investors can. But a question: what kind of investment? Will it be an equity investment? Will you own part of whatever it is? Or will you be investing in lending to real estate projects, real estate ownership and operation? Good question, but not an either or. You could do both, but you should understand what it is you're going after. Of greater interest to Mr. Episcope is the question of whether to invest via a crowdfunding platform or via a sponsor, and he usefully divides up the world into the two. The platform is an intermediary you'd find on the web, which might have many different kinds of opportunities, many different kinds of ways to do it, but which itself doesn't invest in the real estate itself. Sponsor is different. It's a solo entity which owns, controls at least part of the real estate projects, and then you invest with it. Mr. Episcope's firm is of the latter type. He calls the article Malls and Boutiques as metaphors. The real estate crowdfunding platform is more like a mall with many different kinds of choices, whereas the sponsor is more like a boutique, and maybe this will help you divide up the world usefully as well when it comes to that. You can find financially or technologically interesting information in political publications. The Weekly Standard of August 10, 2015 wrote something that I unearthed recently that I hadn't heard about. And I don't know why more of us aren't talking about it. The big news is you can get to the moon in 4 days. Well, you can potentially with this new vetted technology. Rather shocking. It's hard to get to New York from Chicago in 4 did I say 4 days? I meant 4 hours. You can get from the Earth to the moon in 4 hours under this new technology, which again is about as quick as it takes to get from Chicago to New York. In 2006, a British engineer named Roger Scheuer, that's Sawyer with an H in there, announced he designed an electromagnetic propulsion system. It needs no fuel and needs to expel no mass to propel itself. Well, I'm sure the eyes were rolling. Fundamental nature of rocket technology, since Robert Goddard has been used, the force of a rocket exhausting propellant from its engines can propel it through a vacuum. Nope, gonna get above that whole physical issue. Anyway, NASA finally got around to testing it in 2014, and to their astonishment, it worked. A German research group at the Dresden University of Technology performed its own test in a vacuum, and the Scheuer electromagnetic thruster works. And you can find other articles on this. For example, the Telegraph in the UK, July 28, 2015, had an article called Impossible Rocket Proven to Work. Could get to moon in 4 hours. That's kind of fun. Speaking of Robert Goddard, at the beginning of the 20th century, he invented the modern rocket. And of course, the NASA's Goddard Space Flight Center in Greenbelt, Maryland is named after him. However, as the Weekly Standard points out, Goddard's work was mocked throughout the 20s and the 30s, and then became the state of the art and got us to the moon, not in 4 hours, quicker than 4 days. And finally, a note about a short piece on our Financial Poise gatekeeping website, dated February 19, 2016. It's one of the life hacks we have up there, brief articles to address living healthy, wealthy, and wise. I think this falls under healthy, and it's entitled Want to Live Forever. And it discusses it. There are links to an article that takes up that issue in great detail and links to other articles regarding relevant technology. I'm wondering whether it should be under healthy. I'm wondering whether it should be under wise or even wealthy. Think about it. If you live forever, will your wealth hold out? Think about it. Is it wise to live forever? Especially if other people you know aren't living forever. Is it even healthy to live forever? I think if you asked Voldemort or Faust, at this point, they might tell you, well, it was fun for a while. And then it didn't work. But let's get to our guest. We have here with us Tracy Treger. As Senior Director of Corporate Strategy at Syndicated Equities, Tracy helps provide accredited investors with conservative, cash-flowing real estate investments. Her work includes identifying appropriate replacement property to complete tax-deferred 1031 like-kind exchanges, which we're going to talk about today. But she also helps find fractional ownership opportunities for quality commercial real estate. Ms. Treger has more than 20 years of experience in the legal and real estate industries. Tracy, it's great to have you with us here today.
Thanks, Chris. Great to be here.
Okay, so we're going to talk about 1031 like-kind exchanges, and that's an abstract set of words. Let me try to put some meat on it, and then you can correct all my errors as you answer the question.
Sure.
So one can easily understand that if one presumes, as has usually been the case, that real estate prices rise, and one wants to invest in something that's going to rise. Okay, so buy a piece of real estate, look for it to rise, sell that real estate, use the proceeds to buy more real estate, maybe even several pieces of real estate. Continue to do that with the idea that you're going to leave your heirs a nice bit of wealth. But the 1031 like kind exchanges enable you to do all that while avoiding the evil fate of sellers of investment properties, which is a certain kind of tax, long-term capital gains tax. So somehow this 1031 like kind exchange method helps you avoid giving so much money to the government, and it helps you give more money to your heirs. Is that a decent way to start this, Tracy?
Yeah, I mean, I like to think of this, a 1031 exchange is really a strategy for what I call screw uncle, to try and avoid paying your taxes now, pay them later, or maybe never. One of the phrases we use in the business is called swap till you drop. You and your heirs are both benefiting. If you keep exchanging and buying more property, reinvesting your proceeds to buy more and more property at the time that you ultimately drop to the netherworlds, your heirs will get the stepped up basis, the basis in the new property, the most valuable one that you own or properties, and you will have avoided paying capital gains tax, you will avoid depreciation, recapture, a host of taxes, and Uncle Sam will be the one that's detrimented.
So not among the sins you will have to deal with in purgatory is that you paid too much taxes.
Well, you may, but not from that.
Right,
not from your real estate sales.
So this is great. You can save thousands and thousands of dollars, or rather avoid burdening your heirs, legatees, and descendants with unnecessarily diminished returns from all of this activity. But you have to do it you have to comply with certain rules. And one of them is you can't do this with your residence. Is that right?
That's absolutely correct. The property has to be investment property. So you can't exchange an investment property for a house and then move into it and avoid the taxes in that way through a 1031 exchange. There are some examples, some narrow exceptions where if you've got, for example, a home office or you have a vacation home that you rent out for part of the year when you're not there, there are some limited carve-outs that would allow you to do that. But generally speaking, this is for investment property only.
Okay, and it being investment property, it might be wise to have an investment property that itself throws off income, wouldn't it?
Well, yes. I mean, most of the people, if it's not producing income, it's probably not a very good investment, right? There is a type of investment property that we call a zero, where you take a property that's got a long-term, very high credit tenant, like a Walgreens lease, long-term lease, 25, 30-year lease. You put on an enormous mortgage with very little money down, maybe 10% or less, and all of the cash flow goes to servicing the debt for 25 years. So you're not really making any money until the mortgage is paid off, and then you own this beautiful Walgreens free and clear with no mortgage, and all that time you've been taking depreciation deductions, so you get that tax benefit. And then you can sell it, make a lot of dough.
Well, okay, let's turn to the timing rules and how the money gets handled, because those are actually fairly easy to grasp, I think, but also crucial. Let's turn to those.
Yes, absolutely. First and foremost, you want to talk to your tax advisor and make sure that there's actually something there to defer, some gain to defer, some taxes to defer, because otherwise you're going through a lot of work for nothing. The next thing you're going to want to do, of course, is get your qualified intermediary, or sometimes those people are called exchange accommodators, and get that person lined up. And then you're going to want to make sure that both the agreement to sell the property you own and the agreement to buy the new replacement property has what we call an exchange cooperation clause. This is language that acknowledges that an exchange is taking place. This is this is an IRS rule that allows you to do these exchanges and avoid the taxes or defer them. So you can imagine that there's a lot of hoops that are very strict. So you need that language. You can go ahead then and sell your property. All of the net proceeds go directly to the intermediary, and that intermediary holds them until the trade is completed. Any money that goes to the taxpayer, even for a second, gets taxed. Any money that goes to your brother-in-law gets taxed. Any money that is held by some other party gets taxed. So it's only the proceeds that are going directly to that intermediary that can be used for the exchange. You then have 45 days from the time that you have sold your relinquished property to identify prospective replacement property, and then you have an additional 135 days for a total of 180 days from your original sale to actually close on whatever replacement property you're going to buy.
And let's say you end up getting it done on the 181st day. How strictly is that enforced?
It is strictly enforced. You may find an accountant who is willing to date things differently or treat things differently. But generally speaking, it doesn't matter if that 180th day is New Year's Day, Christmas Day, Super Bowl Sunday, or what. They count exactly 180 calendar days. And at that point, if you're not closed, you're paying your tax.
All right, so if you want to avoid these taxes, and I know you do, you have to keep your hands off the money. Just keep it off. Keep them off. Don't touch it. And especially don't let your brother-in-law touch the money. That's why we have the qualified intermediary, and these timing rules are very rigorously enforced. But 6 months is 6 months. I mean, you can get a lot done in 6 months if you genuinely know what you're doing.
Well, that's right. And obviously, it's advanced planning is very, very helpful. You're going to do better if you have planned out the exchange and thought about not only the sale piece of it, which people tend to get really focused, but also on what kinds of things you're going to replace property with. We have people that we call them the 4 a.m.ers, who are the people that will call us here at the office and say, I sold my whatever it is, my Walgreens, and I sold it 40 days ago, and I have 5 more days to come up with something. Do you have something I can invest in? Maybe we do, and maybe we don't. But if you're waiting until the last minute, this is not like the, rush of holiday shoppers on, the morning before Christmas Eve realizing, oh, crap, I didn't buy a gift for, whoever. Planning in advance is really helpful and really important, and also helps to avoid problems if, as things do happen in real estate, your transactions take a little bit longer than you might have hoped.
Waiting till day 44, then leaping onto connectedinvestors.com and trying to find some options might be not quite the way to do it.
I think that's right. I think that's right.
All right. So, and importantly, I think built into your answer, and my first question is that if you have one piece of property, you can exchange it for multiple pieces of property, not just one piece of property. I mean, what's the key in the exchange? It's not one-to-one, but rather, does it have something to do with value?
Yes, the rules are actually, in terms of what you exchange for, is very, very flexible. First of all real estate is considered like kind with all real estate. So if you have a vacant lot, you can exchange a vacant lot for a commercial building. You can exchange soybean farm for a Starbucks with a drive-through. You can exchange oil and gas royalties, any kind of real estate for any other kind of real estate. That's the first thing. Then, as far as what you can identify, there's 3 different rules that are used generally to allow you to identify. The one that tends to be most common is what we call the 3 property rule. You can identify up to 3 alternative replacement properties, regardless of the value of any of those properties. And maybe if they're not real expensive, you sell one expensive property and you buy two less expensive properties. The total value of the property you sold, the relinquished property, has to be less than or equal to, or put differently, what you buy has to be in total be more expensive or equally expensive as what you sold. So one alternative that people do a lot is to identify 3 properties with no restriction. Another another option is to identify what we call 200%. So if the property that you sold had a value of $1 million, you can identify up to $2 million worth of replacement property. That could be 1 building, that could be 20 buildings. It makes no difference as long as you don't go over that 200%. And again, people, sometimes when you're looking at like a portfolio of properties, this is a good way to go because you don't need to worry about how many particular buildings or properties are included. The third rule, which frankly I'm not a big fan of, is what we call the 95% rule. And that rule says that you can identify whatever you'd like, as much or as little as you'd like, but whatever you put down on that paper, you have to acquire at least 95% of it. So basically you have to buy everything within your 180-day period. And the reason why I don't really like this one is because if something goes wrong and a property, you can't close, or a problem happens with the seller, there's a delay, your entire exchange could be blown. So less people use that rule.
Okay, that sounds like kind of a brittle rule, but okay, Tracy, so let's say you're all lined up to buy the new property and they're ready to close. In fact, they want to close, but your old relinquished property, there are problems in getting it sold. So it's not going to be sell and then buy, it's going to be buy and then sell. Does that prevent the 1031 magic from happening?
It does not, actually. There is something called a reverse exchange where you buy your replacement property first. You do this through an entity that your qualified intermediary sets up for you, and they sort of hold on to the property, so to speak, until your sale is completed. A reverse exchange is a lot more expensive and a lot more complicated than the forward or starker kinds of exchanges that we were talking about. Those are other names for the 1031 exchanges, but you can absolutely do them. And when I say more expensive, like a difference between maybe $1,000 or so for a regular exchange and maybe $10,000 to do a reverse exchange. And this is because your intermediary is actually taking on some degree of liability. But you would do it if it is going to save you $100,000 of taxes. Certainly you'd want to do that.
Yes, because we don't want Uncle to be happy. We want to do something to Uncle. Can flippers exploit 1031 and flip to their heart's content without paying any taxes?
Not really, and there's 3 primary reasons for that. A property doesn't count as an investment property unless you purchase it with an intent to hold the property for investment. Now, it's very hard. The IRS is not necessarily going to try and get into your brain to figure out what your intent is, but if you buy a property with an intent to flip it, you're likely to get audited and you're likely to get taxed. Anything that you hold on to for less than a year is a big red flag for the IRS and will trigger an audit. Second, you're probably not going to get a lot of appreciation in the property value or cash flow from the investment in a short period of time that would justify the transaction costs. And then finally, if you buy something and you fix it up and sell it, which is one of the strategies that flippers sometimes like, only the improvements that are done in the 180 days after you've sold the first property will count towards the value of your new property. So if you buy a $1 million property and then put another $1 million into it, but only $100,000 of that is done within your 180-day time frame, your quote unquote value for replacement property purposes is only 1.1 million, not 2 million, even though ultimately the property might be worth more.
So you don't get the tax benefit of that extra investment.
Yes. And I will also mention that when we were talking about the reverse exchanges and those being more expensive, there is something called a construction or a build-to-suit exchange that does allow you to do some fixing up and adding the cost of capital improvements. But again, that's going to be more expensive and more complicated than just doing a straightforward exchange. So I think that's a long-winded way of saying, no, this isn't really a great strategy for the flipper.
I'm glad you, good. Enough about flippers in recent years. So glad you introduced the complexity, by the way, of capital improvements, but there's a huge complexity I've been avoiding, but I'll raise it now, which is not everybody has $1 million. So you end up borrowing money to buy. And how does the borrowed money, the leverage, figure into the 1031 exchange?
Yes. When you are exchanging, what you're looking at is the value of the property that you sold versus the value of the property that you buy. So if, for example, and I'm just again using the round numbers, oftentimes we'll get a call from an investor who's got, oh yeah, I have $1 million in my account, so I only need to worry about the $1 million. And then we say, well, was there a loan? Oh yes, there was also a $500,000 loan. Well, now what they've got to go out and find is a property that is worth at least $1.5 million. And because you add both the equity that's in your pocket or in the QI's account, plus the amount of the loan that you had on the property or on your share of the property. So, yeah, you don't want to get in trouble that way. You can find more, either you could just find a $3 million property and come up with extra cash, or you could take a larger loan and end up with a more expensive property that way. You don't necessarily need to have a loan if you had one in the first instance, as long as the total value of your property is more at the end of the day.
Okay, because you have to match that elevated value to maintain the 1031 benefit.
Right.
All right, great.
And it's also, yeah.
No, go ahead, please.
What I was going to tell you is that let's assume that you don't. Let's assume that you had $1.5 million property, and what you ended up with was only $1.2 million. That will still work for an exchange up to the $1.2 million, and that difference is something that we call the term as boot, which has nothing to do with the shoe store. It's the difference in value between what you sold and what you buy, and you will have to pay tax on that amount.
Okay, so you're not optimizing at that point. That's the suboptimal part, the part that you actually have to pay tax.
Right. Although I will add that a lot of people do that on purpose. For example, they're selling the property and they have something else that they need cash for. I mean, maybe they've got, college tuition to pay for, or a wedding, or, they just want to go on a trip around the world. People do that all the time. They'll pull out some funds and have those funds come directly to them at closing. They won't even bother with the QI account for those monies, and they'll just reinvest the rest. And they understand that any money that comes to them that's not included in the exchange is going to be taxable now, and maybe that's okay. Or maybe they have something else in their investment portfolio that would offset the impact of taking some of that money out now.
Okay, well, let's spend the rest of our time on what could go wrong and on syndication. Syndication being a great opportunity, but before we get to the syndication, because we've been talking about this, and we haven't been talking about it like it's a done deal, and we're not making advice here on this program. I thought I'd mention that. But let's say, what pitfalls are there? Just thinking about the individual case still, what can go wrong? How can it fail? And what did you see during the financial crisis?
Sure. Keeping in mind that all of these things are real estate investments. So sometimes people, you buy something and you think it looks great, and the value ends up declining. Your tenant moves out, or you have multiple tenants, or they rezone your neighborhood and suddenly it's zoned for a landfill and everybody moves away. Or you have, property issues or something like that. Any of those things can go wrong, and then you are stuck with the property, and you can't necessarily sell it. You certainly can't sell it for what it's worth. You've got lenders maybe, knocking on your door. So there's a number of things that can go wrong, and we've seen the whole gambit of that during the recession. One particular instance I'm thinking of, the community, the whole community, the main employer in the community went under and shut down a big factory, and it created all kinds of havoc. So, there's no FDIC insurance for real estate investment.
Let's talk a little bit more then about what your company does, because syndication is another way in which you can buy the property in the first place, another way in which you can manage like-kind exchanges, and maybe even another way you can diversify your real estate portfolio.
Yeah, that's exactly right. Syndication is basically when you have a group of individuals pooling their money together to purchase a property. It's professionally managed. It's often higher quality and or more expensive than what they could buy on their own with the same amount of funds. So think of it as, you want to go and buy the apartment building next door to you, but you don't have enough money. And so you call your friends and you call your family, and you all sort of pool your money together, and together you have enough money to buy this building and own it, have it run together, although in this instance it would be professionally done for you. But that's really a syndication. That's an informal syndication, and a formal one is where you've got a sponsor who does this for a living. It's a business. It's a way for investors to diversify their portfolio, to avoid the hassles of property management on their own, and also, very importantly, you often avoid the need to sign a personal guarantee for the loan if there's going to be leverage on the investment. The sponsor takes care of all of that for you. Sponsor would do the market research, they'll do financial reporting, they'll make sure that rent checks are paid on time, and they make distributions. Could be quarterly, monthly, whatever, you find out what that's going to be. And also, professional syndicators have access very often to off-market opportunities, so that they might be able to get a high-quality piece of real estate for a better price than the individual could get by themselves, either with or without a broker.
We've talked about qualified intermediaries and sponsors, but a little bit more about sponsors. Sponsors really key to a successful syndication, or to optimizing the success of a syndication, both at the beginning and while it's happening and at the end. How do you find a good one, and how much do they cost?
All right, so good sponsors, a really good sponsor is going to have a strong and established track record, and they'll have a track record, they'll share with you the track record, and if they've been in business for any length of time, you're also going to notice that there may be some deals perhaps in the 2007 to 2010 period that maybe didn't go as well as they had hoped for, and if they're honest with you, they'll tell you that. The sponsors would have in their materials will include an opinion from a public accounting firm, a law firm of some substance, often both. Their offerings will include an intended exit strategy, and they'll show you what they think that's going to look like. They will have, if it's a sponsor that's offering something that works for 1031 exchanges, the sponsor should have broker-dealer license, or under the securities laws, or be covered by a broker-dealer. And the people that you're talking to will also have independent registered representative licenses to sell the investments. Another indication of a good sponsor is that they might be a member of trade organizations that deal with 1031 exchanges. But most importantly, a good sponsor is somebody that's going to stick with the investors and stick with the project if things don't go as expected. I mean, anybody can, in a wonderful economy when the property is doing well, anybody can be a good sponsor. But it's what happens when something goes sideways? What happens when a tornado takes off part of the roof of your building and you have to deal with the insurance to get that repaired? How is that communicated? How often is that communicated? Are you able to get your questions answered? All of those things really important, and sometimes you don't find out about that until it's a little bit too late.
Tracy, would a sponsor be putting money in sometimes itself and being a co-indicator?
Absolutely. One of the things that I think we do as a matter of course is that we always personally invest and the company invests in every single deal that we do. So this is not like Lehman Brothers where we throw things out and say, oh, this is something you should do, but we're going to do something else with our money. That would also be a good indication that the sponsor is willing to invest on their own.
I guess we should close then with a perspective of yours, which is, do you think the market for syndicated 1031 like-kind exchanges could potentially expand a lot? Is there demand out there that hasn't been aroused because people don't know about it? And if they did know about it, would you expect that there would be more activity within syndicates or solos? Take advantage.
Well, there is already a real increase and uptick in the 1031, people looking for these 1031 exchanges. And sometimes their accountants suggest that they look into it. There's been a lot of transactions that people wanted to sell things a few years ago and couldn't find lenders or couldn't find buyers. And there's been this sort of pent-up demand. There's also right now a huge demand for what's a somewhat classic standalone kind of property that people own on their own, which is namely a long-term triple net lease with an investment quality type of tenant. And people are paying crazy money for these things. And, perhaps that's good if you want to lock in something like a bond with a 3% return or something in that neighborhood. But it's hard to find the quality investments. Folks that do this professionally, like I said, do tend to have access to slightly better deals, or they're able to engineer them in a way that's more economically feasible. But we are seeing a lot more of these. One caution I will raise is that every year for the past however many, Congress keeps debating as part of their tax reform, should I repeal Section 1031? The Federation of Exchange Accommodators, which is one of the premier, if not the premier, organization for 1031 exchange professionals, has been working very hard in lobbying Congress on this. They've engaged Ernst & Young to do a whole report explaining how these 1031 exchange transactions, which, by the way, not only affect real estate, but you can also exchange personal property like truck fleets, how this benefits the economy. So, given that Congress can't really agree that, what day of the week it is, I'm not real worried that they're going to eliminate this provision anytime soon. But I think people should take advantage of it while they can.
All right, and let me make a little summary statement and see what you make of it. First, even though we weren't giving either one of us any financial or legal advice on this program, you should, given the diversity of syndicated situations, the diversity of properties you might get, and the complexity and need for strict compliance with the rules, you would be well advised to get good advice, financial and legal, before committing to something like this, and take a good look at your sponsor and try to understand as much as you can individually about it. I think that's the right way to sort of begin thinking about this.
I think that's absolutely right. I think most folks, their accountant or tax advisor is the best person to start with. I think having a good intermediary is important because they will keep on top of you and help you with the paperwork and make sure that you're staying on top of the deadlines. And I think working with good professionals as far as your replacement property will help you to locate high-quality replacement property and to allow you to get a little bit of diversity in your portfolio, whether that's geographic or asset type, or to let you split up your funds and invest in a number of different things and, take a lot of burden off of your shoulders, but you've got to do some homework and, get advice, run it by your attorneys, run it by your accountants. Absolutely.
All right. This has been Tracy Treger, Treger, her company is Syndicated Equities. And Tracy, thank you very kindly for participating in this program.
Oh, my pleasure. Thank you for having me.
I'm Christopher Cahill. This has been Accredited Investor Markets Radio, soon to be rebranded as Financial Poise Radio. And in either iteration, Stephanie Strait is the producer of the program. We thank you all for listening. Let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.